Okay, let's do the market wrap up. So heat comes out of the housing market as values across Melbourne dip and Sydney slows. So in continuing what we spoke about last month, Sydney and Melbourne are definitely showing signs of dropping off for obvious reasons. Let's talk about those. While the head, so CoreLogic National Home Value. So I use CoreLogic to get my stats from. Okay, so I credit them. CoreLogic National Home Value rose 0.6% in November, the smallest monthly gain since the growth cycle commenced in February. Now, remember, there's been a growth cycle in February, since February for Melbourne and Sydney, but I know there's been a growth cycle for the rest of the states for at least 2 years now. So we will talk about the the multi-speed market that's happening not only in Australia but in New Zealand. Let's look further. While heading trends have slowed, multi-speed conditions have become increasingly evident across the capitals, with 3 cities recording a decline in value over the month. So let's have a look. Sydney only had a 0.3% growth for the month, November, 1.8 for the quarter, and it's still showing 10.2% growth for the last 12 months. That's because we've had rises since February. Melbourne, negative 0.1%. So, already we're seeing significant change in the market. Only 0.6 growth for the quarter and only showing a 3% growth for the year. So Melbourne has dropped right off and is definitely showing signs of struggle more than anyone in the country. Brisbane, 1.3 for the month, 3.9 for the quarter, and still showing 10.7. So on the whole, Brisbane's still going very, very strong. They did have a dip, but they are certainly performing well at the moment. Adelaide, 1.2 for the month, 3.9 for the quarter, 7.6 for the year. Little old Perth has probably had its best monthly, well, it has, 1.9 for the month. 1.9% growth for the month, 5.4% for the quarter, and 13.5% for the 12 months preceding November. So that is significant, and that has been our best recorded increase, which definitely shows to me that we're kind of getting to the end of it. So we'll talk a bit about that. I don't want to sound pessimistic and everyone's going, "Oh, not us," and that's what agents say in a booming market. But we'll have a look further. Hobart, we won't go to Hobart, Darwin. We don't have any clients there. Canberra, combined capital cities, 0.6 for the month, 2.2 for the quarter, 8.2 annually. Combined regional, 0.6, same, 1.8, very similar for the quarter, and 3.4. So of course, combined capital is still outperforming regional, which is normal. National figures, these are the ones that people look at and they tie it back to their properties, which is not entirely correct. So we've got to be able to say, yes, Mr. and Mrs. Seller, but that was national. We're little old Geraldton or Bunbury or, Frankston or, Christchurch or wherever you are. So 0.6 for the month, 2.1 for the quarter, and 7% growth annually over the last 12 months for national combined. Okay, so let's delve a bit deeper, and then we'll talk about the rental market. Okay, so it is looking increasingly clear that housing market is moving through a new inflection point, with the rate of growth in home values becoming more diverse, but generally weakening. The upswing in housing values since February has been relatively thinly traded and occurred against the backdrop of low inventory. The factors that have supported value growth are losing their potency, with advertised stock levels rising to above average levels in some cities. Downside risk factors have become more pronounced, including an expectation that interest rates could remain higher for longer. worsening affordability challenges and the deeply pessimistic levels of consumer sentiment look to be entrenched. The lower than expected monthly inflation outcome for October may help to allay fears of further rate hikes and lift consumer spirits a little, but the risk of another increase in cash rate remains. We don't expect to see a material lift in housing activity until interest rates reduce, and that isn't likely until the second half of 2024. Adding further downside risk to housing activity is a worsening in housing affordability. The latest housing affordability report for ANZ and CoreLogic showed that worsening across every affordable metric through 2023 to date. The median dwelling value to income ratio rose 7.5. The portion of household income required to service a new mortgage is close to a record high at 46.2%. It now takes an average of 10 years to save a 20% deposit. And the portion of household income dedicated to rental payments has risen to 31%. 2024 is shaping up to be a very different housing market, with expectations that value growth will be lower and more diverse from region to region and across housing types. A few trends to watch for next year: a focused effort on delivering more supply to the Australian housing market. A budgeting housing undersupply is widely acknowledged by government, policymakers, and industry as a crucial issue, with dwelling approvals holding well below average between levels in 2023. It's likely new housing starts will also remain low, despite the national objective of delivering 1.2 million well-located homes in 2029. So we've got some headwinds, to say the least. Rental conditions set to loosen. Now, remember, we have got rental markets remaining extremely tight in November, with capital city vacancy rates at 1%, Adelaide 0.3%, Perth 0.6%, Melbourne 0.8%. The recording of the lowest rental vacancy rates, while Sydney 1.2% and Brisbane 1.3% continue to record rates well below average levels. So that's to take into consideration. November also marks the first time in 6 months where rents have risen at a faster rate than home values, providing some support to gross rental yields nationally. It's likely we are moving through a peak in net overseas migration, but other factors should see vacancy rates rise and rental growth slow, further including a gradual normalization in household size and reduction rental demand as home buyer completion flows through. Build-to-rent developments should also help to gradually add a rental supply. However, we aren't likely to see a massive increase to build-to-rent supply until 2025. Okay, so WA and Queensland look well placed to outperform the rest of the country, given solid interstate migration rates, low supply and less affordability challenges relative to Sydney and Melbourne. Until values also are positioned to outperform relative to houses, given the cheaper price points are budgeting undersupply across the medium to high density sector. Okay, before we move on and get some input from the crew, let's have a look at New Zealand. We do have a number of New Zealand clients, but they're actually going the other end. Hot on the heels of October 0.4 rise in property values, CoreLogic House Price Index shows another rise in November 0.7. The net rise in net average property values are now up by 1.1 over the past 3 months, and the annual change now sits at minus 4.5, the softest annual decline since November last year. From the peak to September 2023 trough, values fell 13.2%. I find that we are just behind New Zealand, especially the last couple of years. It's been very, very interesting. They had significant growth and had significant decline. Sydney and Melbourne had significant growth and I would say quite a reasonable downturn, albeit short and sharp. New Zealand was certainly a lot more aggressive. Signs of an emerging upturn were widespread. Auckland, Hamilton, Tauranga, Wellington, Christchurch all saw monthly rises. So yeah, that's interesting to see what's going on. So of course, we all know that the RBA holds the cash rate at 4.35%. Okay. Expect more for 2024 based on what's happening. Okay. I'm going to flick it back to you guys to get some input from the group about how they're seeing the market. Now, I know that Perth is going great guns and there's no sign in that stopping. But we're going to talk to Peter. What's the time? We've got a bit of time. So we're going to talk to Peter, and it's very interesting. Peter Robertson farms the top end of the market. And what tends to have happened there is definitely sticking of properties, ambitious sellers, and the deals are slow to get done. So there's a significant change in the upper end of the West Australian market. Be aware of that. It's already happening. Okay, enough from me. Over to you guys. Who wants to comment on what they're seeing, how they see the market? Is that accurate? I know that it's a 2-speed or 3-speed or 4-speed market with New Zealand, with smaller cities, with major cities. Over to you. Jill, unmute, please.
Hi, Ryan. Hi, everyone. Trent and I have found that the units are now going, like just flying out the door, and it was the eastern states that were picking them up because of the low cost to buy and the high rental yield. And now all of a sudden the local market is starting to realize that they need to pick them up. So as you know, we sold 10 last month, and the majority of that was units, which we haven't moved that amount of units for a long time. And November was another huge month, and we've sold a lot of apartments. So I feel that bottom end of the market is now moving because the new apartments, well, there's not so many of them coming on anymore, and they're flicking over to ours because ours are about half the price. The rentals, I still feel exceptionally good in our area. We're still holding the prices. The top end of the market, like the 1,500 plus, might be a little bit slower. There's not so many people. We thought we would get more people. That has slowed down a bit. So now I think definitely Peter's right. The top end of the market has slowed down a bit, like over that 2.5 mark. Around here, I noticed that they're sticking. But our market, we can't get enough houses. If we could get houses from 1 million to 2 million, they'd just fly out the door. Mm-hmm. So we're happy at the moment. Our market's good.
Yeah, great, Jill. And I have noticed that, and looking at obviously some of our other unit salespeople, Richard Self has had an enormous best year ever. He's had best quarters ever. He's had best months ever. Records, not unlike you guys. And there has, obviously definitely been a shift to the unit market because of that high rental return and yield. But there is definitely a softening in the top end of the market, and also in the middle end, where people are sort of just taking a little longer. And so I'm just bringing this to the fore. If you look at the figures are definitely dropped, and not the unit people, but the residential housing people, and it could be a stock problem, which I know it is in WA, but certainly there's also a little bit of shifting happening there in the market. But thanks, Jill. Round of applause for Jill. Much appreciated. Who else wants to throw in?
Yeah, I'll jump in.
What's happening?
I'll jump in. if you don't mind.
Yes, mate. Thank you, buddy. How are you?
I agree with everything Jill's saying. I personally, I sell a lot of units. I sell probably half my stock is units, half my stock is houses for the year. Houses are still moving well. You know, one to 1.5, as Jill says, you sell it really quick. The numbers are lower just because, you know, when you're borrowing, a lot of those people are borrowing money, and when they're borrowing at 6%, they're getting assessed at 9%. So there's just less. There are less people buying that than say a year ago or just before the rate rises. But you're still getting multiple offers and selling them, but it's probably not as gangbusters as it was. But the prices are better than they were. But the units, like until all that stock that people have been trying to get out of for a long time now, that haven't been able to get out of their units, is just going to keep getting soaked up, because you've got all the tenants going, well, I don't want to pay that rent, I'll buy it. As an example, last month I had 21 offers on a unit in Yokine, which someone bought like 3 years ago for like half the price. That's 20 more people that want to buy another villa in that same area, and there's nothing available. And that's going to continue to happen. And I don't know about other people that have rent rolls, but my rent roll is eating itself. So every time I get something, I get an investor leaves and sells because they can finally get out of it, or they don't want to pay the interest rates. And the buyers, I have found, everything I'm selling that's a rental, an investment, is getting bought by an owner occupier. So that's investment stock that's coming off, which means there's lower investments for renters to rent, which is pushing the renters out into the sales market. And it's kind of this like vicious cycle, which I can't see changing anytime soon, because the stock's not there. And then the last piece is I do also off the plan sales, and even those are going gangbusters, because people are seeing where the market's going and they're going, let me buy it at today's prices, and in a year's time it'll be finished. And so selling off the plan for me always used to be like pulling teeth, and it was like an added bonus. I'm doing like half of my sales a month in off the plan sales at the moment. So people are recognizing that they're probably, if the market keeps going the way it's going, and it remains the fourth cheapest or sixth cheapest in Australia, that they're probably going to be building equity while whatever they're buying is getting built. And the rent prices will probably have a new baseline. So I don't see it changing anytime soon. We have a massive supply issue going into Christmas, and we always come out of Christmas with less stock than we started with. And January, February, March, April, normally are the big selling months. So I've been chatting with Richard, and we've been joking about where do you think it's going to get to below. I think it's going to get to below 4,000 properties coming out of Christmas on the market.
Great.
That's my little.
Yeah, I love it, mate. Good stuff. And you're right. Rent rolls are being decimated, but not only that. And it's great if you're the owner and you're getting the sales. But not only that, a lot of people know people who are stranded, and then they. Like we've rented our property out to our daughter. So does that take one more out of the rental market? Possibly. So that's happening as well. A lot of people are moving back into their homes. So it's not just that the properties are coming up for sale, but everything has its cycle. Hey, Ashby, you know, I mean, who would have said that off the plan stuff would be going like gangbusters? So everything has its cycle, and that's why we have a cycle, and that's why we have, you know, apartment markets you couldn't poke a stick at 3 years ago. I mean, you could, friggin' hell. I know some properties that were worth less 3 years ago than they were 10 years before that. It was insane. So everything has its cycle. We need to understand that and appreciate that. All I'm saying, and I've been around a long time, over 20 years in this game. I've seen ups and downs. I've seen many ups and downs, and it happens every time. We get caught up. I was talking to Daniel Ferrugia when he was here last month, and he said the same thing. He said when it was going gangbusters, it was just like, he was buying properties in Brisbane. He's got about 8 properties. And all of a sudden it changed. It happens very, very quickly. And all I'm saying is that the signs are there. We've got a saying in horse racing, mate, wait stops trains. And basically what that means is when a horse becomes good in the handicap races, they actually load more weight onto it. It's only a couple of kilos, but for a horse, a couple of kilos is a lot. And depending on how much it keeps winning and what grade they keep it in, they get more, and up to 60 kilos. Some of the other horses carry 52. Even 50 kilos. So you can see that one horse is carrying 10 kilos more than the other. And what tends to happen is it slows the horse down. And in racing, we've got a saying, weight stops trains, meaning it can be the best horse in the world, but if it's got 10 kilos and you've got something half decent, it's going to get beaten. The property market is no different. Interest rates and costs stop the market. So just be mindful. And I don't want to be the guy in 3 months saying, I told you so. All I'm saying, and I'm just kind of mentioning, everybody knows I'm the most optimistic guy on the planet, but I'm also a realist. And the guys who've worked with me for ages know that usually when I'm seeing something in the distance, it happens. So all I would say is go gangbusters, make hay while the sun shines, enjoy the market as it is, but just make sure that you're educating yourself, educating your market on what is happening over East, because it's happening ever so slightly already. And Peter's going to back this up when he jumps in. Big thanks